Thank you very much for joining us. It's a pleasure to have with us Chris Karlin of Aquitania Capital Management. Chris, welcome.
Thank you, Oliver. Pleasure to meet you and have the opportunity to speak with your audience this morning.
Great to have you on the program and learn from you. The topic for today is opportunistic value investing. And be curious, before we get into the topic, if you could tell us a bit about how you got interested in investing and specifically that opportunistic aspect of it.
Sure, I'd be happy to. I think fundamentally it's very valuable to create a life that is your life, that is suited towards you. And I realized at a pretty early age that my personality, my disposition was suited to being drawn to doing things apart from the herd, apart from consensus. And I had started a few small businesses in my youth. I sold a lot of 5.5 or 5.25 inch floppy disks when I was in high school. And I just liked being a part and a little bit different. Around the same time, I started investing without any real clue. But as I grew, as my career progressed, I found myself in a situation where I was doing more event-driven situations. I started out at Karlin as an intern during business school on the risk arbitrage desk, looking at very hard catalysts. And then from there went on to a few firms where I was looking at event-driven situations, spin-offs, distressed, as well as just sort of standard value type situations. And what I found was that my edge, which suited me best from a personality perspective, was to really focus on the things where I could dive in deeply to do the research on a specific event, a specific catalyst for value realization. And I found that I was better at doing that than simply looking at a random stock and saying, is this a good business that's a reasonable price? And not to say I can't do that effectively, but I found that my real attraction, what motivated me, and what I found that I was particularly good at was looking at more catalyst-driven situations. And that has really evolved and been refined over the years based on the opportunities that presented themselves to get to a point where we've ultimately been able to craft Aquitania to focus on those types of situations where we think we can have a demonstrable edge over our counterparties.
So give us a sense then, what does that really mean, the opportunistic investing that you're doing and that catalyst
Sure.
part of it?
Absolutely. I mean, we are looking for situations where we believe our counterparties are making mistakes, where they are making uneconomic decisions. And so that is either because they are uninformed, which is the case with some of our smaller names, where there simply isn't anybody out there doing the depth of research that we're doing. And then there is the actively avoided names. And those can be really across capitalization structures. Those can go much larger. And there are situations where either it's an industry cloud or there's a corporate-specific cloud that is causing people to not want to be associated with the name. We're in many cases looking for situations where an ideal reaction is if we mention this to an investment to other people and their faces curl up and cringe, then we know we're maybe looking at something that we get excited about that. I think, okay, maybe there's something to this. If everybody else is really feeling some degree of disgust at a company or an industry, then it's all the more motivating to me to dig deeper.
Now, of course, in investing, for it to be successful, one has to be not only different, but then also right.
Exactly.
So you've described now some of the conditions for being different.
Yes.
In what you look for. Give us a sense of, the type of work or kind of the situations that perhaps you get attracted to where you also increase the odds of being right.
Yeah, that's exactly correct. Variant is necessary but not sufficient to earn excess returns. You also need to be correct more often than not. And equally important, when you are wrong, you need it to not be so detrimental. You know, you need to have that margin of safety that if I'm wrong, I'm not going to lose much, and if I'm right, I'll do okay. So one of the things that I do, and one of the things that sort of distinguishes Aquitaine, I believe, is that we've sort of turned the research process sort of on end. That instead of starting with a company and saying, you know, here's a company that's landed on my desk today. Let's look at the quality of the business. Let's look at the caliber of the management team. Let's look at the valuation, and look at it in sort of in that vacuum. That's not how we approach it. What I tend to do is to say, okay, what situations in the past, and the past being the last 20 years where I've been doing this professionally, have been associated with situations where there is a wide disparity between the probable truth, the probable outcome, and the current consensus opinion. And so there's a long list that's been developed of these catalyst situations or these bias situations. And so I tend to focus on looking for similar situations first. And then, you know, so if you're looking at companies in bankruptcy or equities as they emerge from bankruptcy, you're looking at spin-offs, you're looking at busted IPOs, situations where we've seen in the past that there has been a broad disparity of belief, and focus on those. That's one thing I think that really distinguishes my research process. And then certainly it's digging deeply to say, well, what are the outcomes here? But more fundamentally than that, it's really a focus on risk control. And so I don't focus as much, and certainly I don't focus first on how much I can make. I focus first, and I focus fundamentally on how can I lose? In what ways could this investment really result in a permanent impairment of capital? In what ways could this sour? And what are the risk factors? Are those risk factors things that are I can get a handle on, that I can have visibility into, that I can research, or is this more of a black box where you're just sort of putting down your bets and hoping that it comes in your favor? There's a big focus on that, and then certainly, you know, if I am wrong, how bad does the downside look? And we are looking for, you know, situations where there are highly asymmetric reward to risk profiles, where it is, you know, if we win, we'll do very, very well, and if events do not unfold as I forecast, I'm not going to get killed in the name. That is of paramount importance, and that's really the driver. You know, I look at the portfolio as a portfolio of risk, and it's a question of how I put that portfolio together, what risks I'm willing to assume, and at what price I'm willing to assume those risks. And the return, that is something that's less in my control. I get to choose which risks I assume. The outcomes, that is a byproduct of what happens in the market, how events unfold. That's a little bit outside my control.
How do you perhaps classify then the various types of risks? When you look at which risks to assume, how do you think about perhaps different levels, categories, and so on of risk?
You know, that's a very interesting question. And it's something that's in continual refinement, and has been, you know, over the last few decades. But it is, you know, there are risks that you're not willing to assume at any price. If you think there are questions of integrity, of honesty, you run. If there are, you know, accounting issues that you think are fundamentally reflective of, you know, are you seeing the underlying economics of the business? Can you understand the underlying economics of the business? Or are the accounting issues making that fluid? We've certainly invested where there are accounting issues, generally where there are you know, failures of reporting and timely reporting. That's something that we're actually drawn to as a catalyst. But if we dig a little bit beneath the surface and say, oh, this is actually the accounting issue, the underlying accounting issue determines how you view the economics of the business, rerun. It's just not worth it. There are other liabilities. In a past life, I did a lot of work on asbestos tort, and that was 2001 through 2004. And so you had an issue where a lot of people were running because they felt that the downside was it was a bottomless pit for these companies. It was just a straight path to bankruptcy to be exposed to this tort. And we looked at it and said, there were real reasons why people have this belief. There were real reasons why you had an acceleration of claims and why the claims were large. And then you, of course, had this confirmed by some bankruptcies actually occurring. But there was a real logical explanation for why this was happening, why it would sort of self-revert even in the absence of meaningful tort reform. And so that was a situation where we gained a great deal of comfort in what many investors looked at as being unmeasurable, imprudently assume that risk. That was an area where we felt very comfortable in the face of what looked to be on the surface uncertainty. So what we're really looking for are situations where can we understand the underlying economics? Are those moving favorably? And is there a wide gap between how the consensus is perceiving this issue and what the underlying fundamental truth might be, or is most probably to be? And those are the cases where it's really interesting. If there's not that much of a gap, then there isn't a margin of safety. But where you have that wide gap between perception and what you believe reality is, and if you have the underlying economics are also working in your favor, so time is your friend in that situation, then it's something that we're very comfortable with. And if those are violated, if the gap's not that wide, if the underlying economics are deteriorating, not likely. And certainly if there's questions of integrity, we run.
Give us a sense of how do you stay opportunistic and are open to many different types of situations, securities, and so on, and then staying within your circle of competence? How do you think about that?
Well, fundamentally, I view my circle of competence as two things. One is, the basics of my job are to look at any given situation and say, assess the risks, and then determine, am I being adequately compensated for the assumption of risk? That's how I view the position. That's the job description. And then in terms of a core competency, I think the core competency is looking at assessing risk. It is assessing risk and assessing valuation. That is fundamentally what I do. And I think, in addition to that, it's the tenacity of the research process of really digging deeply and trying to uncover information, building an information advantage. I think that is one of the advantages that we can build. I view that there are four fundamental ways in which you can determine where you can acquire an edge. There is a trading advantage, which sadly I do not have. I mean, that would be these high frequency people that they can get in milliseconds ahead of effectively legalized front running. That's a trading advantage. I don't have that. Wish I did, never will have it. There's informational advantage, and that, is one of the things that tends to drive us. We're capital market cap agnostic, but I'm very pro information advantage, and so what that leads to effectively is more often than not looking at smaller securities because there's less competition, there's greater access to information, and I can sleep better at night thinking that I truly do have a better handle of the situation than my counterparties and then consensus. There is a behavioral advantage, which I think is really key. And I think on the margin is the determinant between a good value investor and a great value investor. All the greats that we look at, Buffett, Karlin, it's all come down to, on the margin, are they necessarily better analysts? Yeah, they are, but not by the order of magnitude. Where they excel, in my belief, is been on the behavioral traits of knowing when to take risk off the table, of knowing when to how to suffer in the face of adversity, and knowing when to fully commit. I think that's what separates people. I mean, to be opportunistic is to in effect say, listen, I want to be capitalizing on the mistakes of other people, the mental errors, people that are forced sellers. That is what excites me. And if that's how I'm going to choose to invest, then to do that without a behavioral edge it would be fruitless. And so we try to do that. The fourth area where I think we can define myself is structurally, and the idea of not being at an asset size where you are limited in the opportunities that you can look at, in managing the culture of an institution so that you can make rapid decisions and to define your philosophy such that it gives you that breadth to range across geographies, across asset classes, to be both long and short if the opportunity presents itself. And certainly from a business standpoint, looking at who we elect to be partners with as clients. You don't want to attract clients where they don't buy into your philosophy, they don't buy into your process, and because those clients will leave you at exactly the wrong moments. You have to expect that, and that can be very damaging. So to really try and put a lot of effort in cultivating who is a client is a key part of building that structural advantage.
Let's talk a bit about that catalyst part of your investment approach. And I'm curious, how do you think about catalysts? What's the mindset there? Investors often look for catalysts, but what if they're already priced into the stock and everybody knows about the catalyst? How do you make sense of that and use it to your advantage in your opportunistic investment approach?
Sure. I mean, I think there's a wide range of catalysts, and I sort of view it from very, very hard, finite catalysts. Like, risk arbitrage was a great example of that. You had a deal that was closing. It was expected to close in a period of time from now, and the factors are, does this actually close? Does it close at the terms and at the timing that is prescribed, or there's some alterations to that? And it's a catalyst that everybody knows. And yet, in many cases, there were a lot of institutional biases in the marketplace where people weren't interested in being exposed to that risk. And yet, risk arbitrage has come, in and out of favor as a profitable endeavor, and that's also been correlated with interest rates. So I've seen it as being something where I was very focused on at one point in time, and considerably less focused on now. There's another level of sort of spin-offs, bankruptcies, where everyone's sort of seeing the catalyst, but you have an information deficit that if a company is being spun off, there are trading biases relating to institutional holders that were buying to own the parent and didn't necessarily want to buy the spin-off. Generally, if a company is being spun off, it's because there wasn't an alternative buyer, and it's a business that the parent wants to get out of. So there's usually some cloud over the spinoff, and those create biases behavioral biases that persist, which has been surprisingly persistent, frankly, over the last decade or two. You look at the same situation with emergent bankruptcy companies coming out of bankruptcy. They still carry the stigma of going into Chapter 11 and restructuring, and they also There is little information in terms of financials prospectively. So those biases are surprisingly persistent. Then you also have other biases where it is, the ones that are the softer ones are the ones that you tend to get a little less comfortable with, but whether it's a new CEO, a change in management, or a business that's been under a cloud that is emerging from cloud, or a new even so much as a new product cycle. Well, that's not much of what we do, and what it comes down to is fundamentally it's the ability to articulate the counterparty's thesis in a way that may be better than the counterparty can articulate that thesis, and to feel comfortable that that thesis is incorrect. If you do that, then I can feel comfortable with the catalyst that's out there. What is new to me with Aquitania is historically the best valuation situations where there was the biggest gap between current value and what I believed intrinsic value are in situations that there were few catalysts to be identified. And so the thought came, well, why not be the catalyst? And certainly, in the years that I've been in the industry, the changes in media, the ability to communicate, it's been highly democratized, as evidenced by our sitting here in your business. And so the thought is, well, gosh, if there is a company I'm looking at and I see it as being nothing more than just a very deep value play, is there the ability to communicate my thesis to the market and my reasoning, and not to promote, but to educate. And we have done that through private, sort of walled sites, Sum Zero, Value Investors Club, Distressed Investors Club, through public sites like Seeking Alpha, also through our own website, and have gotten some traction. And what's nice about that has been that it's connected us with other investors that are like-minded. Certainly has exposed me to the thesis of my counterparties and helped me refine my thinking and to see what exactly is sort of the consensus. It's a very unfiltered view of that, and that's been very valuable, and that's something that I expect to continue to refine over time.
Give us a sense of what are the main pitfalls to that type of investing where you are opportunistic, you are looking for catalysts or even being the catalyst. Give us a sense of, based on your experience, where that approach can go wrong.
Well, the main way the approach can go wrong is if we do bad work. There's a couple ways that you can go wrong. One is you can go wrong in the research process. You can get things wrong. And that is going to happen. I mean, that's not a hypothetical. I mean, we make mistakes daily. And so the question then is, what mistakes really hurt you? Well, the mistakes that really hurt you are not if you make a mistake about the catalyst. Some catalysts will occur, some catalysts won't. The question is, do you want to be in a situation where the catalyst doesn't develop, that you are so exposed, so dependent upon that one outcome, that if it turns out differently, you are truly going to get hurt. And there certainly have been cases where I've made those mistakes, but they are so unpleasant that it forces you to try very hard to make sure that there is enough of a margin of safety, that you very well might see, okay, if the catalyst doesn't occur, I'm going to suffer. I'm going to have a loss that day. But is it a loss that is permanent, or is it a loss that's recoverable? Are there other paths to value realization? And that is a primary focus. Once again, it comes back to looking at the portfolio as a portfolio of risk and trying to manage that risk accordingly. And the returns sort of take care of themselves. The other way that you can make mistakes is in your risk management of simply being greedy, of not taking some chips off the table during good times, not getting loose on your valuation discipline, of saying, the hardest part in value investing, and maybe even more so in opportunistic value investing, is there are a lot of times when you should be doing nothing. And it's very hard for most people, and particularly for myself, to do nothing. It's just that is difficult, and I think that is one of the biggest challenges, but probably one of the biggest swing factors in determining who is good and who can be great in this business, is knowing when, as Buffett says, waiting for the fat pitch, right? And the emphasis I think most people put on that is the fat pitch. I think the emphasis should really be on the waiting.
How do you go about generating ideas? As you say, when you're opportunistic, it seems like it's so daunting. The whole world is out there, and emphasizing also that waiting aspect, waiting for the fat pitch. Yeah. How do you generate the ideas, and how do you filter through them to make sure you focus on the best ideas?
Well, this is where the structural advantage is huge, because if I had a capital base measured in the billions, I think there would be greater pressure to be doing something now at all times, and on the margin, you would have to allocate to beyond your best ideas, because of the pool of capital. And so in that way, I'm very fortunate that in managing a very small pool of capital presently, that I don't have to go deep down the list to get to the marginal ideas. I can pretty much stay focused on the best ideas. And so the challenge is to have that discipline, because every day you're getting this information flow, and there's always going to be something that's interesting. There's something, there's always something to do. And so to have the discipline of saying, this is nice, this is interesting, and it's good to do the research so that I'm ready if the market presents an opportunity to buy this asset absurdly cheap. But in lieu of that, I don't need to make that many decisions. I really think the key to being successful mentally is to make absolutely no more decisions than you absolutely have to. Make as few as possible, all that are necessary, but as few as possible. Because on the margin, I don't think that you become a better investor by making more decisions. I think you become a better investor by really knowing very deeply what you own and maximizing that. So there's always this continual process of, is this the best portfolio that I could have today? And it's not going to get better by adding more names on the margin. It might be that you say something should be replaced, but it's not, you're not going to get great by just growing the number of names in the portfolio and diversifying it away from the ideas of greatest conviction, of greatest asymmetric reward to risk.
What do you think is key to success in your investment approach when it comes to opportunistic investing with a catalyst? What is really, if you had to identify one or two key aspects, and in a way, what is your advice to investors who are looking to employ that approach successfully?
Well, I think on a pure investment side of it, I think it really comes down to the behavioral. I think I am confident that we could go down to the street and pick a group of 5 people randomly and teach them value investing over the course of a year. I think we could easily convey that. It doesn't take excess IQ. It doesn't take advanced math. It is wholly teachable. That's the basics. That's the price of admission. to on the margin then to take that group and say, okay, let's see who's going to become a great investor. We're going to go away, we're going to give you a pool of capital, we're going to go away for 5 years, we're going to come back, and we're going to see, who did well, and then try and assess why. The ones that are going to do well, in my opinion, are going to be the ones that figure out the behavioral component to it, because anybody can do the math. That's one of the reasons why I'm not so big on screens. I run them, and they're a nice barometer for me for risk, that if I see a lot of ideas coming up on sort of the value screens that everyone's running, it gives me a sense of sort of the temperature of the market, and that helps inform me as to should I be greedy or fearful in this moment. But everybody can do that, and certainly with the computers it's all available at the touch of a button. The insight is certainly to some degree in interpreting all that information and deciding if you view an idea as having, the quality of the business, the quality of the management, and the valuation, there's certainly some art to doing the non-valuation assessments. But fundamentally, what I think is going to distinguish good from great, whether value investing or certainly I think more so with opportunistic, because there's such a high behavioral component, it's who can manage that, who knows that when others are panicking, that is the time to be deploying capital, and when others are jubilant, that is the time to be very fearful. It's Buffett said, be fearful when others are greedy, and greedy when others are fearful, and that is inscribed on my soul. I mean that is just fundamentally how we drive it, and I think that's the swing factor in determining who does well.
And how do you develop that? Give us a sense for over time, when you look back at your career, how have you gotten better at being greedy when others are fearful, and vice versa? Well,
I think it's two things. One, I think fundamentally, you're innately, some of it you're born with. I think some of it is how you view risk, how risk makes you feel, what makes you nauseous, what makes you jubilant. That part of it's just your chemistry. Beyond that, it's experience, right? It's going through and making mistakes and losing capital permanently, and really assessing that. I mean, I have a harder time recalling the successes, but I can recount to you all my losses in painful detail. And so it's how you experience loss, experience risk, how you kick that going forward. Every day I'm making mistakes, but I hope that I can keep it interesting by making new mistakes. It bothers me greatly when I make the same ones over again. And so it's just a continual refinement of that. And really, again, I think for me, it's been that shift over the last few decades of looking at everything first through a risk perspective. How can I lose here? How can I really feel pain? What would cause that? Munger saying, invert, always invert. I know what my desired outcome is, but I focus much more on what could cause my undesired outcome, and I think that's the process.
Well, on that note, Chris, I want to thank you so much for your time and sharing your insights into your opportunistic approach to investing.
Great, thank you, Oliver. It's been a pleasure.